You bought a house, right? Congratulations! The American dream achieved. Keys in hand, now you can finally relax. Meet Bob. He just signed a 30-year mortgage contract, finally locking in his very own piece of the planet.
But then Bob got his first monthly statement, and the excitement quickly started to fade into confusion.
His $2,000 payment was broken down, and he noticed that a massive chunk went directly to the bank's profit. Why is this happening? Why is Bob mostly paying interest on a house he supposedly already owns? It makes zero sense.
This, my friend, is the dark side of your mortgage, a financial concept called amortization that banks never fully explain.
It's a secret banking trick, ensuring that for the first 10 years, your payment is mostly paying their salary, not your principal.
We'll show you exactly how this banking system works and the one trick you can use to escape the interest trap.
By the end of this video, you'll know how to stop paying the bank's salary and start building your own true equity.
This is the dark side of your mortgage, and let's dive into the fine print and expose the real cost of homeownership.
What Bob is experiencing has a very fancy, complicated-sounding name. It is called Loan Amortization. Don't worry, the name itself is designed to make you feel stupid, so you simply stop asking questions about it.
In simple terms, amortization is the schedule banks use to divide your payment between the principal and the interest owed. And here is the absolute dirty little secret. The bank front-loads the interest, especially during the beginning of your loan term. That means for the first decade of your 30-year loan, 80% of your payment is going straight to interest and not the house.
Bob is realizing his American dream is actually an agreement to pay the bank's lavish lifestyle before he can truly own his home.
To really grasp this banking trick, let's use a very simple and delicious analogy. Think of your payment as a giant sandwich.
Your whole house is the bread, and every single payment you make is one bite of filling, split between principal and interest.
But here's the plot twist. The bank manager, who controls the sandwich, has decided to eat the interest part first.
So your payment is mainly his delicious interest filling, and only a tiny crust of principal goes to reducing your total debt. Bob feels like he's trying to pay off the house, but the bank is constantly standing in the way, taking the best part first.
The bank gets its guaranteed profit up front, making sure they profit massively even if you decide to pay the loan off early later. It's a completely legal arrangement designed to maximize the bank's return and minimize your financial freedom early on. Bob finally sees the bank's strategy clearly. Now let's explore the step-by-step mechanism of how this trick is actually done.
All right, let's get technical for a moment, but keep it simple to show you the exact step-by-step mechanism of this amortization.
Step 1. Bob makes his very first mortgage payment, let's say $2,000, happily thinking he is reducing his debt. Step 2. The bank manager calculates the interest based on the entire original loan amount, not the small remaining balance.
Step 3. Your $2,000 payment is allocated. $800 to interest, $200 to the principal. Step 4. That small $200 makes an absolutely minimal dent in your gigantic $300,000 loan.
Step 5. The mechanism resets. Bob is stuck on the interest treadmill, doing all the work but barely moving forward on the principal.
This is the amortization cycle in action, a beautifully designed financial machine that keeps you paying interest for as long as possible.
Let's watch Bob put this mechanism to the test. 5 years have passed, 60 payments, totaling $120,000. Bob figures he's paid off about a quarter of the house by now. His principal should be significantly lower than when he started.
The reality? After 5 years, over $90,000 went straight to interest, and less than $30,000 actually paid the loan.
Wait, what? $90,000 just vanished into the bank's pocket, and Bob is barely closer to actually owning his house.
Bob's actual equity, the value he owns, is still tiny because his payments were engineered to satisfy the bank's interest first.
Bob tries to just pay the principal directly, but the bank politely informs him that he must follow the amortization schedule exactly as written.
It's all written in the fine print you didn't read. You agreed to the system where the interest gets paid first, every single time.
But wait, Bob notices something even weirder on the mortgage statement after watching this video. A hidden complication.
It's a nasty little trap called compounding, which means the bank is calculating interest on your huge unpaid principal balance.
Because Bob's principal payment's so tiny, the total interest calculation barely drops, forcing him to pay maximum interest for years.
Over 30 years, that front-loaded interest combined with compounding means Bob's $300,000 home will truly cost over $600,000.
That's right, Bob is essentially paying for his house twice just to service the bank's upfront interest and that hidden compounding effect.
The system is why, for the first decade, your payments feel like they're vanishing into a black hole with absolutely nothing to show for it. Bob, like most people, used to believe the biggest lie in homeownership. You start building equity with your very first payment.
It seems logical, right? You paid for it. That money must immediately go to reducing your overall liability, not just the fees.
But here is the hard truth. Your minimal principal payment is often swallowed by insurance, taxes, and interest alone. For the first 10 years, your mortgage is essentially an incredibly high-priced, fixed-term, non-refundable rent payment to the bank.
The bank is betting you won't last 30 years, and they made sure they get their full profit before you ever gain substantial equity.
But we know the trick now. The first step to winning is realizing you are fighting a system designed for you to lose slow.
Enough despair. You now fully understand the dark side of your mortgage. It's time to reveal the single trick you can use to escape this trap. The secret is simple, but often misunderstood. You must pay one additional principal-only payment every single year, without fail.
This extra payment directly tackles the big principal amount, which instantly lowers the interest calculation for all the remaining months.
This small adjustment can save you over $100,000 and cut down your 30-year mortgage by nearly 11 years.
Crucially, when you make that extra payment, you absolutely must specify in writing, apply this directly to the principal balance. Otherwise, the bank will automatically just count it as a partial prepayment for next month, and they will still deduct their full interest first.
Implement this tiny change, and you take back control, reducing your debt and forcing the bank to lose a decade of interest profit.